The longer I look at the data, the longer I look at the officially published statistics, I get the impression that this is all just set up to confuse the masses and to concentrate power towards a few. For example, this year, this is the long-term inflation rate. It's a chart that starts in 1915, it goes all the way to today, and this dotted line over here, that's the average inflation rate over the entire time. Now the Federal Reserve has a target of hitting 2% per year. This has not been achieved. On average, we hit 3.3%. But in general, this is the official narrative. So whoever currently works might get an inflation adjustment. They might get whatever is currently measured as how much the money is devaluing. So that's the official narrative. But why do we even measure the value of our money this way? Why do we measure this in consumer prices? Why do we look at a complicated basket of things, housing and food and transport and utilities, and we check how much is this going up and down, and then we come up with some kind of aggregate metric like the inflation rate? Why do we even do this? Wouldn't it be much more honest to just look at how many dollars are currently floating around? For example, this year, this is USM2. USM2 expands by 6.8% per annum. That's over the last 66 years. So the monetary supply increased by 77x. It's a rather constant trend. This is a linear scale. It's pretty much a straight line on a logarithmic scale. So the percent changes over time stay constant. Where does the mismatch come from? When the US dollars that are available in the system grows by 6.8%, but officially we only see the money devaluing by 3.3%, and that's probably already artificially lowered, right? The government has an incentive to push down this number. But let's say this is actually real. Let's say consumer goods only go up by 3.3% per year. Who gets the remainder? Where are those other 3.5% per year? The answer, of course, lies it's with the elites. It's with the people that have assets such as stocks or property or gold. All of those things go up over time, measured in US dollars, and that's just because there's so many more dollars floating. Now, dollar creation happens through credit creation, so people that have access to cheap credit, they are the beneficiaries of the system. They get the remaining 3.5%. Now, why do I say this is all intentional? Because maybe people simply just get more risk on, maybe they just take on more debt, and that's occasionally growing quicker than prices do. So maybe it does make sense to measure prices in all of those categories. Maybe we should not measure the purchasing power of the US dollar by how much gold we could buy with it. Yes, I do understand that argument, but I'm not convinced, because there's other statistics given out by the government that obviously makes zero sense and where the government is focusing on. For example, the US GDP. The US GDP is also measured in US dollars, but we've already established how the US dollar is losing value over time. What would be much more honest is to look at the GDP and put this in relation to how many dollars are currently floating around. Or in other words, if there was no money printer, how much is the economy actually growing? So let's look at the US GDP relative to the money supply. How much growth do we then have? The unfortunate truth is not much at all. And we all intuitively feel this, right? There was a time where things were quite good. The GDP expanded from the 1960s to 1997. But then came the turnaround. Since then, so in the last 30 years, roughly, the GDP measured in a constant money supply went down by 38%. Now the monetary base is going up faster than consumer goods. So maybe it's not a fair comparison to look at GDP versus the money supply. Maybe we should look at GDP relative to the inflation rate. But that then again blurs the picture, because really the base is growing by 6.8%. It's just that half of that growth goes to the asset holders. But still, for argument's sake, how much did we actually go down here per year? The answer is 1.7% every single year. The officially measured inflation rate since 1997 is 2.5% on average. Now, why do those things matter? It matters because whatever officials believe is representative of typical spending might not be representative for you, because probably you do want to buy a house at one point. Probably you do want to have some financial security by buying gold. Probably you do want to own pieces of companies so that you're safe for retirement. But of course, the returns of companies tend to go down because valuations just go up much faster. And that's again because of the money printer. The official narrative cannot be that the US economy is weak, because that would also weaken its demand for the debt. That would also put some pressure on the government, and it might reignite the fight between the haves and have-nots. Telling everybody that the money devalues by only 3.3% per annum while everything is growing nicely and smoothly, that's a much better story to sell. Telling the average Joe that their money is devaluing by 6.8% per annum while they only got an inflation adjustment of 3.3%, that's a very tough story. That's not something that the elites want you to know. Pretty much all of the return of the S&P 500 over the years is just caused by monetary debasement. It's just because of an expansion, more and more dollars floating around. This is the S&P 500 relative to the money supply. And this is not constantly growing. This is rather trading in a range, with the average ratio being again the dotted line. And currently we are, by the way, 93% above that average. So the S&P 500 could potentially fall by 48%, which is also in line with historical yield estimations. Well, let's turn this around. The Shiller PE ratio. If the Shiller PE ratio was to fall by roughly 50%, if that was to be at 20 instead of at 40, that would very much be a reasonable long-term expectation. Don't trust the official narrative. Try to increase your income by at least 6.8% per annum through whatever means it is, changing jobs, adding side hustles, whatever it is. This is the minimum rate that you have to grow with in order not to fall behind. And don't trust the official narrative that we are growing and that everybody is having a good time. Even the entire system shrunk in purchasing power. And while the very wealthy have been preserved from that contraction to a degree because asset prices went up and because monetary debasement goes to the asset holders long term, a potential correction won't be pleasant even for the elites. The system is rigged against most, but if you've got access to cheap leverage and you can buy assets that are currently not too expensive, so let's say you can lock in a very low interest rate for a long time and you can buy cheap property with it, then probably you're starting to gain from the system, to be among the few winners. If you got some value out of this video, then feel free to give this a like. It will help the video spread via the algorithm. Of course, feel free to subscribe as well. I publish videos regularly over here. By the way, if you want to know how I structure my portfolio and how I make money in the system, there's a lot of tutorial videos. There's also premium updates where I talk about the current market situation. Feel free to check it out. It's down below, thebitcoinstrategy.com.